Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of how to use MACD for profitable trading strategies. Mastering MACD, a beginner's guide to this powerful trading indicator. The Moving Average Convergence Divergence (MACD) indicator is a trusted tool among traders and investors. It's used to identify trends, momentum shifts, and potential trade opportunities in financial markets. Known for its simplicity and effectiveness, MACD has become one of the most popular indicators in technical analysis. Whether you're a beginner exploring trading or someone looking to refine your strategy, understanding MACD can help you make more informed decisions. What is MACD? MACD, or Moving Average Convergence Divergence, is a popular tool in technical analysis. Traders use it to spot trends, gauge momentum, and find potential buy or sell signals. By combining trend following and momentum characteristics, it provides a clearer view of market conditions. Whether you're a new trader or an experienced investor, understanding MACD can add depth to your strategy and improve decision-making. Definition of MACD. MACD stands for Moving Average Convergence Divergence. It's a momentum oscillator and a trend-following indicator rolled into one. Despite being plotted as lines in a histogram, MACD isn't bound by fixed ranges like other oscillators. Instead, it shows the relationship between two moving averages of an asset's price. At its core, MACD tracks the difference, or divergence, between a short-term moving average and a long-term moving average. When these moving averages converge, it can signal a weakening trend. When they diverge, it could indicate stronger momentum in the trend's direction. Traders rely on MACD to spot key momentum shifts and trend reversals. Components of MACD. MACD is made up of 3 main parts that work together to provide insights: the MACD line, the signal line, and the histogram. Each plays a distinct role in helping traders understand market behavior. MACD line. This line represents the difference between two exponential moving averages, typically the 12-day and 26-day EMA. It tells you whether short-term momentum is stronger or weaker compared to long-term momentum. When the MACD line crosses above or below the signal line, it can indicate potential buy or sell opportunities. Signal line. The signal line is a 9-day EMA of the MACD line. Think of it as a smoother, slower-moving version of the MACD line. Traders use this line to confirm signals. For example, if the MACD line crosses above the signal line, it might suggest bullish momentum, while a cross below could signal bearish activity. Histogram. The histogram is a bar graph that plots the difference between the MACD line and the signal line. It offers a quick visual of momentum changes. When the bars rise above 0, it suggests positive momentum. When they dip below 0, it indicates negative momentum. The size and direction of the bars can help traders gauge the strength of a trend. Together, these 3 components form a comprehensive tool that simplifies complex market movements into actionable data. By learning how each part interacts, traders can get a better read on what the market might do next. How is MACD calculated? Understanding how MACD is calculated can demystify its usefulness in technical analysis. By breaking it down into its key components, traders can see how it measures momentum and identifies potential trading opportunities. The MACD line formula. The MACD line is the foundation of this indicator. It's calculated by subtracting a long-term exponential moving average, EMA, from a shorter-term EMA. Typically, the 12-day EMA, short-term, and the 26-day EMA, long-term, are used in the formula. MACD line equals 12-day EMA minus 26-day EMA. Why use EMAs instead of simple moving averages, SMAs? EMAs give more weight to recent price data, making them more responsive to market changes. This responsiveness gives traders a clearer view of momentum shifts as they happen. When the MACD line moves above 0, it shows that the short-term average is greater than the long-term average, signaling upward momentum. Conversely, when it falls below 0, it indicates downward momentum. This zero-line crossover can be a key signal for traders. Understanding the signal line. The signal line serves as a guide to smooth out MACD line fluctuations. It's calculated using a 9-day EMA of the MACD line. While the MACD line reacts quickly to price changes, the signal line acts like a slower moving counterpart, helping traders confirm trends. When the MACD line crosses above the signal line, it often indicates a potential buy signal. On the other hand, when it crosses below, it could signify a sell signal. Think of this as a checkpoint to add more clarity before making moves. The relationship between these two lines is what generates many of the actionable signals in MACD. The histogram and its role. The histogram is the visual tool that simplifies the difference between the MACD line and the signal line. Its calculation is straightforward. Histogram equals MACD line minus signal line. What makes the histogram so valuable is its ability to show momentum at a glance. When the histogram's bars rise above the zero line, it points to increasing bullish momentum. When the bars dip below zero, bearish momentum is picking up. The size of the bars matters, too. Larger bars indicate a widening gap between the MACD line and signal line, suggesting stronger momentum. Smaller bars suggest the two lines are converging, which might hint at an upcoming trend reversal. Essentially, the histogram is like a heartbeat monitor for trend strength. It tells you if the market pulse is quickening or slowing down. By keeping these calculations in mind, you can utilize the MACD indicator more effectively. It's not just about the numbers, it's about understanding the story they tell about market momentum and trends. Interpreting MACD signals. The Moving Average Convergence Divergence (MACD) indicator offers a wealth of insights for understanding market movement. To make this tool work for you, it's essential to know how to interpret its signals. Traders rely on MACD to spot trends, reversals, and momentum shifts, but the real value lies in how you read its key features. Let's break down 3 crucial ways to interpret MACD signals. Bullish and bearish crossovers. Crossovers between the MACD line and the signal line are some of the most widely used signals in trading. They offer clear, actionable clues about where the market might be heading. A bullish crossover occurs when the MACD line crosses above the signal line. This often points to upward momentum, suggesting it might be time to buy or go long. A bearish crossover happens when the MACD line drops below the signal line. This indicates growing downward momentum, which could mean it's time to sell or go short. Think of these crossovers as traffic lights for trading. A bullish crossover is the green light signaling, go, while a bearish crossover is the red light advising caution or a potential stop. However, crossovers are not foolproof. They tend to work better in trending markets than in choppy, sideways ones. Always look for confirmation with other indicators or price action. Divergence and its implications. Divergence is a powerful signal that can hint at potential trend reversals. It happens when the direction of the MACD does not align with price action. Bullish divergence occurs when prices are making lower lows, but the MACD forms higher lows. This suggests the downtrend is losing steam, and a reversal to the upside might be on the horizon. Bearish divergence is when prices hit higher highs, but the MACD makes lower highs. Here, the uptrend might be weakening, signaling a possible downturn. Divergence is like spotting cracks in a wall. It doesn't always mean an immediate collapse, but it's worth paying attention to. It's more effective when used with other tools, such as support and resistance levels or candlestick patterns. Spotting divergence takes practice, but once you get the hang of it, it can be a game changer in your analysis. Zero-line crossovers. The zero line, or the baseline, divides positive momentum from negative momentum. Watching how the MACD line interacts with this line gives another layer of insight. When the MACD line crosses above the zero line, it signals a shift toward bullish momentum. This is often interpreted as confirmation of an upward trend. When the MACD line crosses below the zero line, it indicates bearish momentum, often aligned with a downward trend. Zero-line crossovers are like checkpoints. They help confirm the overall market direction, especially when paired with crossovers or divergence signals. However, don't jump to conclusions too quickly. A false crossover isn't uncommon, especially in volatile markets. By understanding these 3 core signals, crossovers, divergence, and zero-line crossovers, you'll strengthen your ability to interpret the MACD indicator and make informed trading decisions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.